This is Alan Bush with the Daily Financial Forecast for Thursday, January 28th. In the stock index futures, we did start out higher with overnight gains showing some follow-through strength. However, we did get the durable goods report showing a 5.1% decline. That compares to a relatively small decrease. So stock indices coming off of their highs and in fact trading down to just steady on the day. However, all of this changing very suddenly on reports that it is possible that crude oil producers may be cutting back production, or at least there's a possibility at some of the upcoming meetings that there could be some type of an agreement to reduce oil production. So that quickly supported the energy markets, at least the crude oil advanced very sharply. That in turn caused stock index futures to very suddenly advance. So stock indices putting in a good performance, ignoring the bearish durable goods report and instead focusing on energy prices. Still thinking longer term that the low interest rate environment that we have globally will support stock indices on a worldwide basis. Now, moving over to the currencies, the dollar index coming under a little pressure, mainly due to the durable goods report coming in as weak as it did. This also supporting some of the other currencies, such as the euro currency and the British pound. Also, the pound was able to advance with better than expected economic numbers overall. In fact, we did have fourth quarter GDP coming in up 0.5% in the UK, and that compares to the third quarter GDP increase of 0.4%. And retail sales in Japan unexpectedly declining, so that puts some pressure on the Japanese yen. And the commodity currencies, the Canadian dollar and the Australian, both advancing, and this primarily due to the quick surge that we saw in the crude oil prices. Now, moving over to the interest rate futures markets, I'd have to say that the 30-year bonds are very much underperforming the news. We should have had some type of strength, or at least good gains, with the durable goods report coming in as weak as it did. Of course, that would suggest a slowing economy, and a slowing economy then is bullish for the credit markets. And yet bonds not performing that well, in fact trading lower, instead focusing on the crude oil prices that advanced. So with crude oil advancing, of course that's inflationary, that being a negative for the long end of the curve. So we continue to believe that the 30-year bonds are in overbought territory, and they are likely to move lower from current levels. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.